Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Tuesday pre-market prep. Spencer Israel, Joel Elconin, Dennis Dick. I hope wherever you are warm and you have power and you're doing okay. I am the only person in the Benzinga office right now. Everyone else is afraid of snow, I guess, is the only conclusion there. They are afraid of a little bit of snow, but the show must go on. It cannot stop me. It cannot stop pre-market prep. Let's go. On today's show, Bitcoin keeps on going. Actually, the whole market keeps on going. We're going to talk the market's reaction to the weekend, whether rallies in natural gas, rallies in crude. We've got more crypto stocks on our radar. I want to talk AMC. I want to talk Palantir. So a lot to get to on today's show. Our guest is Bill Harts. He is a market structure expert. He's the former CEO of Modern Markets Initiative. He'll be on at 8:35. We'll talk more about market structure with him. Don't forget to hit that like button, hit subscribe, hit share wherever you're watching this show. Thank you very much. Joel, how was your nice long President's Day weekend?
Nice and snowy, but here we are. We're back at the markets. S&P futures, just a little dip on Sunday night, not even a dip. 34.75. We've been highs 59 and a quarter. Been hanging out at 39.50 for a long time, so we'll see if we can get up to that pre-market high.
Show us those charts.
I thought I did share the charts.
Well, yeah, you got Palantir up there.
Oh, okay. Don't we want to talk about Palantir?
Eventually.
All right, and then you have crude. That got over $60. The cold is definitely influencing that. You got up to 60.33, back under 60. See if we can get that magical close over 60. Gold and silver, they're going opposite ways. Gold's down 18.40 at 18.04.80, while silver's going up. That's up 2.7 cents at 27.35, and Bitcoin over 50K. Long weekend, it jumped above and below that. Right now, the futures are up $2,000 and $2,055 and $50,095. And Spencer, since you're the only one in the office today, I will buy lunch for the office. Okay? Treats on me.
I appreciate that. Thank you, Joel.
Can you get something out of the cafeteria? What are they? What are they doing with that cafeteria?
Is it
Lisa
closed?
asked me about that.
Is it closed too?
No, it's been open, but it's got limited operations. You can only go during certain times and order certain things, but it's open.
Really? Okay.
Yeah. All right. I will pass the message to everyone else here, mainly my friends behind me, that you're going to be buying lunch for us today. We appreciate.
Watch
that.
everyone show up now. like everyone's.
I'm coming. I'm driving down to go there right now, Joel. Except I don't know if they'll let me across the border.
Probably not.
Borders are still closed, eh? Essential. This is essential, though. I need to get the lunch from Joel. He owes me like 25 lunches. So I think it's sometime.
I think it's 26.
Is it 26 you owe me now? There's a lot of lunches Joel owes me, anyways. What do you think?
Right.
What do you think? I mean, okay, first of all, shocking that we're up substantially after a long weekend. That's sarcasm, in case you didn't realize.
Hashtag sarcasm.
Bitcoin, the 50,000 hat. I mean, we hit it. 50,000. So now what? What do we do now? I'm still long Bitcoin. I don't know what to do with it.
You're going to stick to your original plan, and you're not
zero or what was the target? 500,000, which was the twins, the twins,
the Winklevi.
The Winkles, the Winkle twins,
the Winklevoss twins. Yes.
So that's what we're going with. We're going with the Winklevoss twins at 500,000 or zero. So I'm going to stick with that. That's what I'm doing because I sold half. So again, playing with that was his money. Just going to stick with it. You tell me what to do.
That's what I've been doing, Dennis.
You're long too. I didn't realize that.
Well, I went into Coinbase. I actually made a Coinbase account.
Oh, so you're actually holding the actual Bitcoin.
Yeah.
That's smart.
Yeah.
Don't forget your 12-word password, though. See, I'd forget that, and Joel would too. That's why We got to own him. Actually, Joel did good though when he was in there. He didn't forget his words either.
You just said you were going to buy it and forget about it. That's what
I know,
you said.
but it keeps going up, and you just can't seem to forget about it.
I see no reason to sell. You know, the institutions are coming in now. The big banks are. Even J.P. Morgan is coming out saying we're going to have to work with Bitcoin in some way. We're going to have to offer it in some way. Yeah. I see no reason. I don't know. It could go back to 20 for all we know, but
it could go anywhere.
It could go anywhere, but I see no reason. Look, I mean, for me, like I've got such a small piece, I see no reason to do anything with it.
And me too. I mean, it's a small piece.
Yeah.
I said it was going to be, you think about story stocks and how much this market is about a story. I mean, I've said it last year. I was like, what better story? This is why I bought Bitcoin. Like, what better story than Bitcoin for 2021? Am I buying it on fundamentals? No. I'm buying it because it's a story. And that story continues to remain hot. And I think the story gets hotter in 2021. I think it continues to remain hot and gets hotter. And that's why if it stays hot, the story, it probably continues to go higher. So that's my whole thesis is not fundamentals. Not that we're going to all be transacting in Bitcoin and buying everything. I just think it's a story.
Yeah, out of the dollar. I mean, just about out of the dollar.
Wow.
Into everything. Out of the dollar into everything else is basically.
There's a good point there too. I mean, this has just been the worst place to be is the dollar. You're seeing the rise, in everything. If you're sitting in cash, you are just hurting because obviously it was a great move in February, but I took a while to get back out of cash because I had raised so much cash worried about the pandemic, and there was a lot of people that stayed worried about it for too long. And they're being punished, We got inflation coming. It's not inflation of stuff you buy. It's at least the inflation of assets. Everything going up. Like the sports cards. I don't know if you guys are into sports cards, but those are just blasting off too. I mean, collectibles, artwork. It's everything. We saw a dinosaur bone sell for $28 million. It's literally everything is just moving up in price.
What about
here.
coins?
Probably. Collectible coins?
Yeah.
Probably. I'm not even sure. Anything collectible market, though. So if anybody does collectibles on coins, let us know. Coin collectors in the chat right now. He must know.
But also, just because assets are going up doesn't mean that they can't go up for a long time.
Oh, for sure.
Right? So just because they seem more expensive now than they were 12 months ago doesn't mean they can't keep going up for 2, 3, 4, 5 more years. You know what I mean? I mean,
yeah. How do you call it top?
Right.
I mean, that's what it all comes back to with everything is, even in the market. I mean, one thing, though, is we have a separation here, and we've got to talk about that. We've been talking about it. But the mega caps are being left out here.
Yep.
And that might continue. People are looking for the quick buck. We've talked about the consumer staples. It started with the consumer staples, with Coke selling off and Procter & Gamble selling off. Look at Procter & Gamble. Clorox is selling off now. I mean, it started with the consumer staples, really. And now they're just selling, other, assets like mega caps that aren't participating to buy smaller cap names that are outperforming the market by a substantial margin. I mean, again, we look at Amazon, the great quarter. The stock cannot go anywhere. Apple is not participating here. We've had a nice rally in the market here for the last couple of weeks. Really, Apple has gone nowhere. So Facebook, it's kind of the same story. It's just hanging out. Now, Twitter, smaller name, has exploded with their earnings. So it is selective. But if you're looking at the big, like the $300, $400, $500 billion company, I guess you got to go even bigger than that now. But, you're getting over $500 billion. A lot of those companies are not participating in this rally. So what does that mean overall? I don't know. Because it's been driven so much by mega caps. The last 10 years have been driven by mega caps, and this is being driven by small cap.
Which may not be a bad thing, right?
Catch-up trade?
Yeah. I mean, all those years where the big caps were outperforming, and now, and when things turn, they turn. So
they do.
Yeah. I'm just like, I'm looking at the top 10 components, top 11 components of the S&P, and boy, oh boy, it's going to take a while to get those big boys out of there. But you just, you want to, obviously they're different indexes, but as long as...
Go to the top 5. Go to the top 5 right now. It's a good exercise.
Yeah. Apple,
so obviously,
nowhere.
Apple, nowhere. Amazon nowhere. Keep going.
Mr. Softy's number 2. That's been look at that.
It's holding up, but really put it in perspective. I mean, you're seeing these huge moves, and it had a great report, and really since that report, it's really gone nowhere too. It is at all-time highs. It's holding up, but it isn't like people are flying into Microsoft every morning. The market's up, and Microsoft's up $3-4. That's not happening. Microsoft's not up again today. I mean, it's up 0.27%. Definitely underperforming.
You know what's interesting is that this area is what it hit in the after hours when it reported earnings. That's really where I remember it got to 244, 245, and just think how much the market has rallied since then. Amazon, I mean, great report. I mean, look at that same kind of chart. They just sold it. I think Google a little bit different. I think Google broke out, right? I mean, it's had that's a holding pattern if I've ever seen one. That's for Google.
Not participating now. Like, It looks like a cup and handle. It looks like it's ready to go. But because it's mega cap, it's like, I don't know. Mega cap is just not going. I think if people start to, get burned in some of these small cap names eventually, maybe some of it moves back in there. I'm not sure. I mean, most majority of people's portfolios are full of mega cap. If you own SPY, you're full of mega cap. You're full of mega cap. If you own any ETF, for the most part, you're full of mega cap. And I own some of these directly too. I own Google, Amazon, Microsoft, Apple, all directly as well. I've owned them for years, and they've all been great. But they are not the stocks that are helping your portfolio right now. It's the small cap names. Like you were saying last week, great point, Spencer. I ran a scan too for stocks under $1, and there was 4. So, like you were saying, 2, maybe a couple fell back under, but 4 stocks listed. Now, again, exchanges have requirements. So, it's not like there's a bazillion stocks under $1. When they fall under, a lot of them do delist them and send them to the pinks. But still, there's usually quite a few names that are still under $1. 4 stocks. I mean, they've just went through every stock. Like, even when I was running the filters before and looking, and running the scans, you're tough, like, to find stocks, a smaller cap name that hasn't gone up substantially. So it's been just combing through the ditches, and they're buying everything that's small cap.
I mean, it's hard. Every day you wake up and by the time it gets to 8 a.m., 9 a.m., there's another stock that's doubled right for the day. Like today, it's WBAI, which I guess is off the highs or so, but there's a new crypto stock every day.
That's a crypto play, another one?
Yeah. They bought a I guess the company's BTC.com and the related businesses, and they're paying in stock, in their own stock for it. But and that's one of like 4 or 5 new crypto stocks that's just up huge this morning. It's hard. It's hard.
You want to do crypto stocks, or do you want?
It's flying through the Mara. Mara's up again. You're up another $4, and obviously, guest last week saying same thing. That this is a leverage play on crypto. Absolutely correct. Crypto keeps going up. Mara probably keeps going up right along with it. Riot blockchain, same thing. These are 2 of the big names. And then the other one, which you were saying, MSTR. You said they're doing an offering today?
That's correct.
So this is just a different world.
A $600 million offering of convertible senior notes. So not a stock offering. Also, did you catch the news from Thursday? Canada, Dennis, your people beat us.
My people.
Yeah, your people beat us to a Bitcoin ETF.
What do we got? What is it?
You approved, Canadians approved the first Bitcoin ETF. It is coming to the market in Canada.
Wow, I should go buy some of that too, maybe.
Well, it's not open yet, but yeah, when it does open, you're gonna have the first one.
Look at that. Well, Bitcoin ETF is coming. I mean, as it gets more adoption here, it's coming. So, they didn't want to approve it because it's hard to regulate. It's hard to regulate the crypto market. We know there's a lot of market manipulation in there. But at the same time, you're getting real players. Like you were saying, Spencer, you're getting real players coming into here.
Yep.
Yeah, there's participation here. I mean, I look at it. Does it have longevity? Is it going to be? That's still unknown. I mean, the people who are putting all their money in Bitcoin here are taking a shot. And it might work out. It might not. I just want to get off zero. Like Mark Yusko said, I don't want to be, left out if, it's FOMO. I really own Bitcoin because of FOMO. And it had a good technical setup. and it has a story. Those are the 3 reasons. So I don't know where, like this could continue for a long time, but do you really think that we're all going to transact in Bitcoin one day? Spencer, what do you think? I just don't see it. It's just not, to be honest, it's not very efficient. It's not easy to go say, okay, I'm going to buy a loaf of bread. It's going to be like I've said before, 0.00002 Bitcoins. I mean, what if they're typing it in and they throw a decimal place off? Or whatever, like in the price. I mean, it's confusing. It's just not efficient. They got to find a different way. It's just, when you're talking fractions and fractions of a penny to pay for something small. Sure, you go buy a car and it costs you a Bitcoin and a half, or it costs you a Bitcoin. I mean, okay, but it's just not that efficient to transact in that. But I'm not talking it down. I still own it because the story is still there.
You know what? Dan makes a good point. And I was just thinking is when so you buy a car in Bitcoin today, like what's the settlement? Like it's at 50,000 right now and you pay for it, and with the transaction, the settlement 2 days, could be a 52,000, could be a 48,000. I mean, how for everyday use, but we're talking common sense here. We're talking fundamentals. Could we stop doing that, please?
I know, you're right.
Yeah.
Bill. You have
Come
to just
on,
stop
get us?
talking common sense, because the market doesn't care about common sense.
Hell no.
It's true. It's true. This market doesn't care about common sense. This market cares about the quick buck. And the quick buck is still being made, obviously, in the small cap names and in these storied stocks, and there's a million more. The SPACs, which I'm participating into, have remained hot. And then, you do have this smaller, the tech names are still hot. It's just not mega tech. It's, the smaller tech. Like you're seeing huge run-ups in smaller tech names, like, a Twilio, for instance, has run substantially. I mean, it's $441 now. I mean, these are big moves. Back in the summer we were 200, so the stock is more than doubled. So you're seeing smaller names still doing well, and not that Twilio is small anymore, but it's not participating in the mega caps. So I don't know if you should I'm bringing it back to that, because I don't know if you should be repositioning here, or if it's like, okay, they've run so far, the mega caps eventually going to participate here again. It's such an interesting market because these dynamics we haven't seen, even though we've seen the market going up for years and years and years, we haven't seen mega cap getting left in the dust like this.
All right, let's shift gears here. And you guys always crush me on movies, right? You and Dennis and Spencer with all your movie quotes. So with what's going on in our environment right now, what movie am I thinking about? And where did the movie take place?
Are you kidding me?
We're gonna crush this on you.
Wait. What was the question? What movie are you thinking of right now? Are you for real?
I'm talking about
he's gonna give us a hint.
The environment. What's going on in the environment right now?
Are you for real?
In the country? Oh, come on! You
gotta narrow it down a little bit more than that.
Kidding me?
You gotta get narrowed down.
What did we talk about on the pre-market show? What stocks are we going to talk about?
The Blizzard.
Yeah, Blizzard. Yeah.
Is that what you're talking about? The Blizzard?
Yeah.
The Big Chill?
Yeah, there you go.
All right. It's because you wrote it in the thing. But like,
you guys complaining about your snow. I mean, you should go, okay, Spencer, show the picture I just sent you, because this is what it looks like outside where I'm at for the last 3 months. It never changes. The picture always looks the same.
It's hard to see.
Well, you can put it up on, you could do it the other way. You don't have to do it that way. But anyways, that's outside my place, yeah. So
right.
That picnic table, that snow has been there. It's just like that. The snow comes and it just doesn't go away up here. I'm up near, I'm up way up north, and it's there's a lot of snow up here.
And where did that movie take place?
Joel,
no idea.
Trivia.
Oh, come on. You guys,
wait, I have an update.
Guys.
I have an update. I am not the only person in
You're
the office
big
anymore.
movie guys.
Luke,
wait, we got another person just entered. Who is it?
Luke Jacoby, welcome to the office.
Hot Stocks Luke is there.
Luke
he made it.
He's about 2 hours later than normal, but he's here.
You guys and you're complaining about your blizzards. It snows here every single day. We get 5-6 inches of snow, and it just doesn't go away. They don't even give us blizzard warnings up here. That's just a normal Monday. That's what they call this. When you get like 6 inches of snow, they call it Monday. That's what they call it here. Tuesday, Wednesday. It snowed for like 10 days in a row.
Well, the market is not treating it as such because if you look at energy, you look at natural gas, you look at Generac, GNRC this morning.
Soft market.
Just anyways, it took place University of Michigan anyways.
Okay.
University of Michigan grads.
It
had a Michigan relation.
Thanks.
Yeah, Generac, Dennis. I'm surprised that with you this was not one that you were just scooping up for a while. You couldn't do much.
I didn't even know about the blizzards here all the time. You guys got to tell me there's a blizzard coming in your neck of the woods because there's always a blizzard here.
It's
blizzard.
I
shrugged that off.
It's snowed in Texas. Do you know where that is? That is south.
I'm just saying.
They have rolling blackouts, and
you guys are all soft, man. You guys, the snow. It's what nothing you can do. It's everywhere. I'm in the snow belt.
I think it's funny that Dennis missed out on a trade because he genuinely wasn't aware.
No, I wasn't. I didn't know it was a blizzard coming. It snows every day. There's always a blizzard here in the snow belt of Ontario.
I trade relationships.
He didn't even know.
You can't even look at the goddamn weather map to know that you buy.
My weather map looks the same every day. There's a cloud over the area, and it's snowing. It looks the same every day.
Watch something else besides CBC. And
CBC, Canada. We just got a permanent cloud sitting over northern. As soon as you get out of southwestern Ontario, it's the only area that doesn't get pounded with snow.
Let's get some snow stocks here.
All right, give me snow stocks. GNRC is always a good one.
How about John Deere? People need tractors and plows.
I don't know if they think that far. It's up $3. It's up $4. Yeah, okay, we'll give it to you.
I guess we can say just about anything.
Throw me under the bus. I didn't even know it was a blizzard.
Does iRobot have a automated snow shoveler? That would be interesting. That's up to $250.
They should come out with that.
Natural gas. I mean, Dennis, it's a bad situation in Texas. I mean, they're doing rolling blackouts because
did they not know this was coming?
It's not about that. It's the way the electric grid in Texas and the way the utility companies work in Texas. It's structured differently than like it is in other states where it's much. I don't know if you want to say like freer, more open, less monopolized, and so these utility companies don't really plan for major. First of all, they don't have like the infrastructure like the snow plows and salt and all that stuff, but also like the electrical grid, the companies don't really plan for like usage spikes like you would get during a blizzard, right? So they just don't have the infrastructure for it.
Yeah, they're like regulating, like you can't turn your thermostat up over 68. They're like regulating your thermostats and stuff.
Chatter listeners who are in Texas, you would know more than I. I'm just relaying what I've read about it over the weekend.
Yeah.
But it's the way the electric companies are structured down there. It's different than, for example, it's not like in California where like P&G can just like, shut down the grid for X amount of time, right? To help fight wildfires. It's not like that. So, but I would also look at like energy. I would look at XLE today. I would look at natural gas.
It's all up big.
Yeah, that's where I would look.
Maybe the one thing about this is this an event that eventually, like, I still think when you're buying all these oil stocks and people are plowing into oil stocks now that we're going back to $100 a barrel. The electrification of cars is still coming. We're going to have less demand for gas-guzzling vehicles, and I think in turn less demand for oil stocks, going in the foreseeable future, really. It's not even like decades. It's not a decade away anymore. It's coming. So is this your opportunity? If you've been sitting in all these oil stocks and, they've got pounded on you all year, but they've come back. Is this eventually not your opportunity to lighten those up? If you're really believing in the electrification of cars.
Yeah, but they're talking a long time. I know these companies are coming out and saying, "Yeah, we're doing this," but I don't know. I kind of thought that 5-6 years ago, but I don't know.
I don't want to own any oil stocks. I just think if you're in those things, I think it's the opportunity to start getting out of them. Everything's going up right now. Bag holder market. There's been a lot of bag holders in a lot of oil stocks, and this market has bailing those holders out as well to a certain. I mean, ExxonMobil isn't back at $100, but it's 51 from 32 in November. I mean, if you're coming in buying it now, you're way late to the party. And I think, just like I was saying, I like the Bitcoin story. I hate the oil story. I still hate the oil story. So I just think if you're in these things, I think it's the opportunity that you've been looking for to maybe lighten up. If you like it, you want to stick with them, sure, but don't have all your money in oil, in my opinion.
You know what's interesting? Just that it had the quick rebound off the March low, but it hasn't even taken out the June high. So I know it's been playing catch up major league with the oil market, but just considering that it's not even above, it's getting back above its February high. It's not above its June high. And then if you look at it, from a long-term perspective, what was the all-time high in that? Was that it was back here in 14 when it was the top component in the index. So on a relative basis, I mean, you can either look at it it's got a lot of catch-up to do, or this is just a dead cat bounce on a long-term trend that started in the middle of 2014.
I think it is. I mean, people are arguing, oil isn't going away. I'm not arguing that oil is going away. I'm arguing that the demand is going to go down. And when businesses demand goes slightly down, it really hurts. So, you don't want to see demand actually. Everything is about growth, right? You're always driving into growth. I don't see oil as this huge growth opportunity. So if it stays flat, it's going to be a bad investment. If demand actually goes down, it's going to be a terrible investment. Well, you need it to continue to go up. That's about what investing is. It's about growth. I don't see the growth in oil. So I'm not saying oil is going away. I'm saying I don't see the growth. I don't see why. In this, world where everybody knows, a lot of younger generation that's concerned about the environment. There's a lot of younger generation that loves the thought of solar power. There's a lot of the younger generation that loves the thoughts of electric cars. Why do you want to own oil?
Well, it's not like it's not like the companies haven't said that they're trying to pivot. They are. I mean, they've all said.
Where are they going to pivot from?
What are they going to do? Some of them. I see Suncor has a lot of wind turbines in Ontario. I mean, they're trying.
Let's not act like they're doing nothing.
What's ExxonMobil?
No, Spencer, and I'm not saying all these companies are going away. That's, again, people say, I talk bearish, I'm negative. I'm such a negative person. I'm talking realistically. I mean, we've been talking bearish on oil for a long time on this show, and we've been absolutely correct. We've been absolutely correct. Because, I sold my ExxonMobil at $95. And I said that day 5 years ago when I sold it, I had owned ExxonMobil in my portfolio for years. And I was like, I don't want to own oil stocks anymore. This was probably back in about 2016. Maybe it was 2015. It's $50 5 years later. So you lost 50% of your money 5 years later. We've been absolutely correct to not own these things. Did they get oversold? Maybe. But is it going back to 95? In this market, anything's possible, but I don't see the fundamental case.
There you go again.
To drive it back up.
There you go again with your fundamentals. I don't know why. I don't know.
It's not a story. So fundamentals don't matter. But what's the good oil story? Tell me the story to make me come back into my ExxonMobil. I can scalp $50 on it right now. Yep. I can scalp $50 on my ExxonMobil. I owned it at 95, 45 points. I can scalp out 5 years, move that money into something else. It was a great long-term holding for me for a long time. I can scalp 45 points on it. Talk me into it, chat. Talk me into why I should buy an oil company. Tell me. I don't know what the story is.
Dividends.
No, it's not a story in an environment.
I'm gonna go wash your mouth
where
out
people want to make 10% a day. And you're going to give me 6% a year.
All right.
Dividends.
All right. Sorry.
Dividends.
That's a dirty word. I'm sorry.
So okay, that's my point. So you can invest how you want to invest, but I don't want to own something that I don't think it has a sexy story. I think the oil has the opposite of that. I think it has a growth story because it's not clean energy, and we are moving towards clean energy. We've got Biden in there. We are moving towards clean energy.
Yep.
Yeah, I mean, look, it is very simple. If you look at the top performing ETFs of the year so far, and take away leverage, they all have one thing in common. They're all investing in like the future, right? Whether that's cannabis or technology or crypto or AI, robotics, whatever.
Yes.
The bets on the future are in. Everything else is out.
And this oil rally hasn't been driven about bets to the future. It's been driven because everything is going up right now. It's being just caught up in the tide. The tide, a rising tide, they say a sinking tide sinks all, or a rising tide lifts all ships. It does. You have a rising tide right now that is lifting the majority of your ships. And that's what I believe is happening with the oil rally. Just, inflation to a certain extent hitting it. But I just don't see it.
All right, it's 8:30 here. We're gonna have Bill Harts on in 5 minutes. Let's just cover some other stocks here. I do want to talk AMC because last time when I woke up this morning, and you happened on Twitter at the time, AMC was the most traded stock of the session. It is not quite there anymore, but still heavy volume on AMC this morning. I don't know why. I have not seen any news. I just know it opened weirdly higher for some reason.
It's that 4 a.m. juice, man.
Yeah.
Look at that. I mean, that's all just...
Day trade 4 a.m.
Yeah. It took a little bit. I think that's just, taking an algorithm that's just figured out, you can bid, and then, you finally snuff out the sellers, and then you sell. If there's for this thing to go 580 to 680, and then now back down to $6. I mean, do we have any? There's no news, right? I mean, I guess things are getting better with the as far as like the vaccines and stuff go. But when is everyone rushing out and going to the movies? Wasn't that a dying trend? And Gene Mustard talked about this. It was a dying trend before the pandemic.
Yes,
right.
It was. Yeah, for sure.
Look at these stocks. Look at AMC before. I mean, it had that ridiculous run, but look at this thing. It was back in 2017. I mean, people don't want to pay $9 for, greasy popcorn and $6 for a Coke. And now they don't want to sit next to each other. So, I mean, these stocks are going to have, this has a better fundamental story than GameStop. And unless there's some alternative use for these theaters, I don't know what it is. But
I don't know. We're never gonna know why like these stocks trade like this. Like why did AMC?
I think I think that's purely mechanical trick. Just bots, just bidding in a thin market, bidding. When you're bidding like that, when you're being aggressive, when someone wants to sell. When you find an offer. When someone wants to kick your butt, and that these algorithms can do that, and it turns. They're like, oh well. Let's turn the machine on the other way. Let's jam it down, take profits, because that's a big bar. I don't know how much volume traded on that, but anyways, let's do Palantir.
Somebody was saying that AMC popped on a Forbes headline. So
no,
I don't know what that was either.
Sorry, no.
Just
Forbes.
Sorry,
okay.
Not buying.
I think AMC is just still the Reddit crowd, and they do. At 4 a.m. they're all excited.
Yep.
This is it's going to turn around. The problem is, again, to do this again to these stocks. I'm not saying they can't do it, but it's a lot harder because there's so many people who bought recently that are burned, and all those people want to get out. They want their money back. I mean, you read the horror stories over the weekend from GameStop, and there was a couple articles that I tweeted out as well, and some person taking out a $20,000 line of credit to go buy GameStop. I mean, this stuff you just don't do. Yeah, that's what the article was. And now he says eventually it's going to come back, so I'm just going to keep paying the interest at 11%, to hold the GameStop position. I mean, this is the downside.
I also read that. I also read that article. Yeah, and you almost never hear of the people who lost, so it's good
because they don't want to write it.
Right.
It's not fun.
Well,
but,
they do, but people don't want to talk about it.
People don't want to talk about it. Yeah.
But,
so there's a lot of people that made money. GameStop. A lot of people got burned. We know this is how these things go. If you're in these things, this trades, you gotta get out when the momentum gets when the momentum turns. And GameStop, I just couldn't control the risk. That's why I wasn't participating in it at all. But wow. So
by the way. S&Ps are fading here for some reason. I don't know. I think the high of the day
I
at
would
59.
bet you the mega caps. Yep. Amazon is almost in the red now. Apple, Facebook, Netflix to a certain extent, it's red now. The big guns are not participating. It is a concern. It is a concern because this market, that's why I keep coming back to them, because this market, it's so much of the SPY. I mean, how much of those top 10 components, Joel?
25%.
25%. They're not participating. So one of two things. There's going to eventually be a catch-up trade. Money's just going to fly into these. Maybe it flies out of this other stuff and goes, but there's money that is coming out of mega cap and going into small cap. This stuff is more indicative of happens more at market tops than it does happen at really awesome investment opportunities. Again, I'm almost fully invested, so I'm not like ringing the, get out of everything here. You just got to be careful, because I will, obviously as a trader, I'll go both ways, and if the going gets tough, you've got to be careful here, because you're not buying cheap. You're coming here and you're investing your dollars now. Nothing's that cheap.
All right, I guess we'll do Palantir. Do we got Bill afterwards?
We do. We'll do Palantir after Bill. Bill Harts is a former CEO of Modern Markets Initiative. Last time he was on our show, he blew my freaking mind. So maybe, I don't know if he has that up his sleeve again this time. But Bill,
smart.
Good morning.
Hi, how are you guys? Thanks for having me on again.
Thanks for coming back. So what has been on your mind these last 2 weeks, that as far as how these crazy trades sort of shook out? The story is not quite over yet. I mean, we're still learning new things all the time. The CEO of Robinhood, et cetera, are set to testify in front of Congress. But as far as how the story's played out these past few weeks, has anything surprised you on that front?
Yeah, well, I think there's obviously been this real emphasis on payment for order flow and whether or not it might lead to conflicts of interest between brokers and their clients and how they route orders and so on. But in my opinion, this is a story we've seen before. And look, let me just point out, this is not the first rodeo for payment for order flow by any means. Before you guys start with the hot takes on OK Boomer, let me just tell you about a lot of this actually goes back to like the 1980s when payment for order flow first started gaining some traction, and the NASD, which was the predecessor of today's FINRA, put together a blue ribbon committee. Was chaired by an ex-chairman of the SEC named David Reuter, and the Reuter Commission was basically set up. Sorry. The Reuter Commission was basically set up to look into this, and they came out with this big report in I think it was '89, and there were three big takeaways. The first one was the payment for order flow was basically a means of returning outsized intermediary profits to brokers and their investors. Number two, that there were many different kinds of payment for order flow, and some of which would be hard to put a value on. And number three was that payment for order flow could be beneficial to investors by doing things like lowering broker costs, leading to free commissions. And here we are 30 years later, and that's pretty much what happened. So the SEC and FINRA have said for years that payment for order flow is fine, assuming, with two big caveats. Number one, that there's proper disclosure, that the brokers tell their clients that they're receiving payment for order flow. And number two, that it does not interfere with obtaining best execution of the client orders. And that's the key thing to watch for as we go forward and see these congressional hearings and so on, because that's really, I think, what they're going to hone in on. Are clients getting the best execution? And, quite often, best execution, you'll hear the term price improvement and how much price improvement are orders getting and so on. And just recently, we've learned that several brokers have started to disclose, Robinhood, Schwab, Ameritrade, these price improvement numbers that are much higher than people have thought, which is a good thing for investors. And so the interesting thing is going to be to watch when you see these hearings is that the regulators, the SEC and FINRA, they've known about this for years. They've been surveilling it. They, when necessary, they swoop in and levy fines and so on. It'll be interesting to see if they have to defend what they've done to Congress. It should make for some very interesting viewing.
I just got a couple comments there too, Bill, and I agree. Like what I see, and obviously I've been a big critic of payment for order flow for a long time, but I do see the improvement that you're talking about. Like I used to see when we started talking about this, Joel, back in like 2009. You'd see what I would call like sub-pennying the quote, where you're seeing this 0.0001 price improvement. And I did like a study with Bright Trading. It was like something like 28% of orders were getting like 1/1000th of a penny price improvement I was like, is this price improvement 0.0001 really enough price improvement to justify taking a fill away from a displayed liquidity provider? And I've argued that for a long time. But what you're arguing is that you're starting to see more competition here, and you're starting to see that PI. You're not seeing as much of this 0.0001 stuff where somebody's just effectively trying to jump the lit order queue by giving a fraction of a cent better. So you're actually starting to see more competition, and you're starting to see the PI more significant than this 0.0001 stuff that we saw for years.
That's right. I think that the brokers, the market makers, have evolved to a point where they really are giving back significant amounts of PI, between 2 and 5 cents a share when you look at Robinhood and Schwab and Ameritrade. And I mean, that's on average, and it generally goes by a percentage of the spread. So no one should expect to get 3 cents price improvement on a stock with 3 cents spread. That just makes no sense. No. But in general, I think we are seeing significant price improvement now. But when you start watching these hearings, I think what people have to keep in mind, and I like to say this, is you have to say, well, price and payment for order flow, maybe it's good, maybe it's bad, but compared to what? And ask yourself, what would happen if Congress or the SEC or someone decided to ban hard cash payment for order flow? And it's actually a good mental exercise to do this, because these are the questions that the Congress people and the senators are really going to come up on very quickly. So let me just give you a couple of quick bullet points on this. So if you banned payment for order flow, hard cash payment for order flow, early on, what that would mean, it would be a windfall for the market makers, because market makers have proven that their execution quality is as good as or better than what you can get on an exchange. So brokers would probably continue to route to them to get best execution, but they no longer have to pay for the flow. So it would save themselves a bunch of money. And believe me, I'm not trying to hype Virtu stock, but just imagine what would happen to their valuation if you added back all the PFOF money that they currently pay out. So that's number one. And that would become apparent pretty quickly if they eliminated payment for order flow. Number two, brokers could set up their own internalization desk upstairs. This was very common in the 1990s. Every broker, Merrill Lynch, Smith Barney, they all had NASDAQ desks upstairs. And so they basically internalized their own flow. It's a little harder to do that today. It's expensive to set up. You need some rocket scientists to figure out the algorithms. But theoretically they could do that. But here's another thing that could happen if hard cash payments were made illegal. Basically, the brokers who currently route to market makers could own a piece of a company that is a market maker or an exchange. And therefore, if that company made a profit, they would share in the profits through their ownership, and they would still direct their order flow to that company. So the big example of this was, everybody remembers Knight, I'm sure, the nightmare where an algorithm went haywire and basically put the company out of business. Knight, for a long time, was one of the leading market makers of NASDAQ stocks. And it was actually formed by 27 brokers who got together. It was called the Round Table Partners. That's how it became known as Knight of the Round Table, Knights of the Round Table. And these brokers basically said, okay, look, we're going to build this market maker, and if the market maker makes money, we'll share in that, and we'll send our order flow to it. And that was very successful for a long time. Today, you don't have that right now. It could happen. You have broker-owned exchanges like Memex most recently, and MIAX also is partly broker-owned. So there are different ways to skin that cat. But let me just point out, from a disclosure perspective, that these things are worse than payment for order flow, because at least with payment for order flow, you know how much money is changing hands. If some firm sets up an upstairs trading desk, you don't really know how much they're making from it. There could be all kinds of costs loaded in, and it'd be very hard to disclose it. So anyway, at the end of the day, what I think is going to happen is you'll see increased attention to the practice. There'll probably be another blue ribbon panel set up to study payment for order flow again. Yeah. But at the end of the day, there'll probably be little change from Congress or the regulators.
I think you make a great point with, and obviously my concern overall is the toxicity, and we know we're going to start to get ahead of our listeners, so we've got to bring it down a level maybe. But I'm concerned that there's so much informed traders just on the exchange, and all the uninformed flow is being kept off the exchange. So as a market maker, as a lit market maker, if you're making markets on the exchange, you don't want to trade, with informed traders. You don't make money trading against other prop traders. You don't make money trading against informed traders. As a market maker, you make money trading against uninformed flow. Typically, retail is more that flow. That flow being kept off the exchange is what I say increases the toxicity of order flow on the exchange and makes it less attractive for firms like ourselves to provide liquidity. So to put it in perspective, because the way the markets have evolved over the last 11 years and so much retail flow being kept off the exchange, our firm has went from primarily providing liquidity to primarily taking liquidity. We've adjusted to the environment. And our traders are doing very well, but we take liquidity. We lift the offer, we hit the bid, we maybe go 2/3 through if we're small enough to not affect it, but we're coming through as opposed to sitting out there. So the point you were making is, even if you get and you ban payment for order flow, those orders, those retail orders, are likely not coming back onto the exchange. And I think a main reason for that too, which we haven't talked about, is access fees. Is you can't have, Robinhood routing out to Arca and paying 0.3 of a penny to get filled on that order. They're going to get crushed on that. So, I mean, if you're going to ban payment for order flow, you've got to look at the access fees on the exchange too and say, well, you got to ban them as well. You can't just take away the payments that way, because you can't obviously the brokers are never going to route anything to the exchange in any regard, because they don't want to make those payments. So you can take away their gravy train, maybe the PFOF, maybe they got to add some commissions. But like you say, they're probably still not routing their orders to an ARCA offer or an offer they got to pay 0.3 to take it. So I think
you're making a great point. I mean, look, when all this started, the exchanges were considered the gold standard of execution quality, and it was up to the market makers to prove that they could do as well or better than an execution on an exchange. Mm-hmm. Today, I think it's all sort of flipped on its head, where the market makers are generally considered to have the best execution quality, and it's up to the exchanges to give a good reason why a broker should route to them, whether or not they pay payment for order flow. And they do, by the way. They're called exchange rebates. So, but I get your point. If orders continue to drain away from the exchanges, what will happen to the quality of price discovery? I think there are mechanisms in place that will ensure that the exchange quotes will continue to reflect what's happening off exchange. But that's another topic that the regulators are certainly.
Bill, let me hop in here for a second. We're on with Bill Harts. He's a former CEO of Modern Markets Initiative, and I might be a little off base here in some of my assumptions here, but Dennis, you can correct me if I'm wrong. So, these one thing about trading, let me make this statement, whether you're a short-term trader, long-term trader, one thing about trading is like taking losses, right? I mean, whether they're small losses or big losses, invested in discipline, right? But when I kind of look at like the payment for order flow, it's like I kind of feel that they can't lose. Like almost every trade, almost every execution, they make money on. And if they can't do that, or they can't break even, then they pass it on to the exchange. So I'm not saying it's riskless trading, and I might be a little bit off base on this, but when you have the option of taking the other side of a trade or passing it on to the street, that's not an even playing field for you.
That's why we can say there's lots of PI, but also we can look at the bottom line. A lot of these offshore markets, they made a lot of money. Yeah, I mean it's such a good system for an off-exchange market maker. We don't have to name them here. You guys know all the ones we're talking about. But I mean, it's such a huge edge to be able to take the other side, to have that option, to take this other side of this trade coming through. And again, when you're looking at retail, you're looking at a smaller trades typically. So it's, when you're taking the other side of a trade, and it could be an institution coming through, you don't know, like you sell it here, they're coming with more and they're coming with more, and now you're getting buried. Where typically smaller retail traders, it's going to be back and forth. Just like even, the stats that we were looking, from Citadel with GME. I mean, that was pretty even, the buying and selling. So that's ideal for a market maker because they can keep flipping out on the bid and the ask.
Yep.
So I think what Bill's saying is if you get rid of payment for order flow, I don't know if that, goes away. I don't know if that goes away by just eliminating.
If you're getting through 0.3 of a penny on something, that means that they made 0.6 of a penny.
It is. They're making the spread.
I mean, it is.
You're right.
I mean, don't tell me about price improvement at 0.3. The only reason you're getting that improvement is because of whatever market dynamic was. If they had another order in the book, they're not giving you the brokers that advertise that. Price improvement. Well, you're not getting your full price improvement, and there's nothing you can say that would convince me that every price improvement that they get on these executions is passed on to the brokers and passed on to the customers.
They're making on the spread. You're arguing that point. So let's let Bill address that.
Yeah, no, I mean, look, I understand what you're saying. I think the first thing that you have to understand is that over the course of a day, a market maker is up and down all the time, right? They're not profitable on every trade.
For sure.
Not the way it works, right? And so there's nothing that says, market maker looks at an order, if this isn't profitable, he passes on to the exchange. That's not what happens. And in fact, the amount of flow that market makers pass on to the exchange is a small fraction of what they generally trade with every day. But in terms of you being skeptical about how much price improvement you're getting, what I would say is do a test, right? Send one order through Robinhood or Schwab or Ameritrade and send another one where it's going directly to an exchange and see how they both come back. And I think what you'll find is that in general, the market maker trades are going to be better prices.
Yeah, well, it's the difference between markets and limits, right? Because typically, and this is something that's been said for a long time. I mean, the off-exchange market makers are buying market orders. The exchanges are buying limit orders. I mean, that's really what you're doing by having rebates attached to those. So, like, you just look at what Joel's saying is, you got this market maker that it's a big edge. I mean, it's a big edge for sure on the spread. It gives you a big advantage, and they're paying for that advantage. So they're not doing this out of the goodness of their heart. They're not giving the PI out of the goodness of their heart. But I see Bill's argument that even if you get rid of the PI, they're probably still getting those orders, so that stuff isn't going away. We're not going back to the days where 100% of the flow's going to be on the exchange anymore. That ship has sailed. Like I argued that for a long time. I wanted to bring flow back on the exchange because I thought price discovery's being impaired. And the small cap names, and some of them it probably is to a certain extent, but it's held up very well in a lot of other names. So there's good arguments on both sides. I see both sides of this.
And one other thing too is like when things really get crazy and stuff, these guys don't have an affirmative obligation. There used to be market makers that had to post a two-sided market, and even when things got wild and you were getting like picked off, there's no affirmative obligation. Hey, this is getting let's shut her down for a little bit. I mean, that's another thing that is a little.
Well, you could take it a step further too. Maybe Bill could address that too. Is the off-exchange market maker not even about affirmative obligations? They're not even posting a market. I mean, they're basically free riding on the public quote. So you're not even posting a market up there. So the risk. And, we've been market makers for a long time, Bill. But it's true though.
When we talk about affirmative obligations, generally, what you're going back to are things like what exchange specialists used to have, right? And it wasn't so much to make a two-sided quote, although that was part of it. And by the way, today, market makers, of course, are always publishing continuous two-sided quotes. In fact, they'll often post quotes deeper than what the NBBO quote is.
The lit ones, but the off-exchange ones don't have to.
No.
Yeah.
So
most of the off-exchange market makers are lit market makers too, though.
Right. So
they're on both places.
My point is that maybe in the old days with the exchange specialist, there was an exchange rule that said, you couldn't move a stock by more than an eighth or a quarter, right? We were talking about, 12 cents at that time, 12 and a half cents, without some intervening trade. That was what was known as an affirmative obligation. Yeah. Today, we've sort of evolved to a point where, spreads are so narrow that maybe that's not as important anymore, but maybe depth at the inside is more important. And so market makers as a competitive measure, often will execute trades that are much larger than what's shown at the inside. So I would argue that
Size
there are
improvement.
these obligations. Maybe they're not written down somewhere, but in fact, the retail investors that whose orders are being sent to market makers benefit from them.
I mean, that's size improvement you're talking about, and
Yeah.
that's another argument for, like I said, I can see both sides, and I think there's a happy medium of, where the markets are most efficient to have a certain amount of volume going off exchange and a certain amount of volume going on exchange. Do we want to go back to 100% on the exchange? It's not going there, so it's unrealistic to hope that would happen. But, at a certain point, is there a tipping point? I'll just maybe finish with that. Is there a tipping point if we start seeing 70, 80%? I mean, we're at 44% or something right now. If we start seeing like 3/4 or 2/3 of our orders going off exchange, is there a tipping point where it does start to impair price discovery?
Yeah, I don't know that there's a set point. I think we're closer to 50 right now. But
okay, so it's going up.
It can be measured in shares. It can be measured in notional value. There's a lot of
Sure.
haziness around. But I don't know. I think, look, a lot of people don't realize that even when a market maker holds a limit order off exchange unexecuted, that limit order still has to be reflected in the NBBO on exchange. So the price discovery mechanism actually, would still be happening even though that order is not literally on the exchange. So hard to say at where there would be a tipping point. I'm not sure there is. I think, it's something that obviously the regulators pay a lot of attention to.
Well, it's been a great conversation. I know we're going above the head of a lot of listeners here, but I think sometimes we got to dig into the plumbing. Digging into the plumbing, and Bill's a great plumber here, and I respect Bill Harts so much. I've followed him for years on Twitter. Give him a follow here. He knows his stuff. We're kind of on the opposite sides on this argument. I'm on the same side as Bill on a lot of stuff. I see as a point here, though, on payment for order flow. So, Bill, I just want to say thanks again for coming on. We want to have you back because I want to talk financial transaction tax with you next time.
Yeah, we should talk about the FTT. Right.
Yeah, for sure. Thanks so much, Bill.
Thanks, guys.
Hey, Dennis, just real quick, we did running into the details, and you're talking about lit market, trade, and then also the NBBO. Those terms, I don't know if anyone is super familiar with those.
I mean, we're going above. The national best bid and offer is basically your lit quote. So you just think about it as the quote you're seeing. So the big point here is, there's a lot of volume going off exchange. When you send your order from Robinhood, it's typically not going to the exchange. It's going to an off exchange market maker that's going to probably execute against it. So your orders aren't getting to the exchange. I'm at Bright trading on the exchange. So in all likelihood, there's a very low likelihood that you will ever trade against me because there'll be somebody jumping in the middle. There'll be somebody jumping in the middle. So if I go to, if you come in, if I'm offering a stock and you go to lift my offer, in all likelihood, somebody's going to jump in the middle. An off-exchange market maker is going to jump in to stop you from taking my offer. And that's where you start to get into, the plumbing of the markets. And, we're looking at, is it fair that offer, that I'm offering the stock, I'm the person offering it out there, but I don't get the sale because we have another person has the option basically to come in and say, no, I'm going to jump in the middle of this trade. I mean, and that's in the plumbing, and, we're talking, but, Bill's point was you get rid of payment for order flow, that stuff's still all going to exist. And that's a good point.
All right, let's do Palantir. As the market erodes here, and I don't know, Dennis.
It's the mega caps going by. I know this is Amazon's down $6 here now, too. I don't like it. My long-term portfolio is not liking the lack of participation from the mega caps, but they're just not going. People want to get in this next set. How many small names do we have? I mean, look at the chat. This is a great example too, Spencer. What's the chat want to talk about? They want to talk about Sanddial or Sundial or whatever the hell it is. They do. They want to talk about the small little names because that's where people are getting. That's what's sexy right now. That's where people are making money. They don't want to talk about, plumbing. They don't want to talk about Amazon. They want to talk about, a lot, not everyone, but a lot of people want to talk about the small names. So that's just indicative of the market we're in.
Yeah, very last thing. It's not really about what we just talked about, but it's tangentially related. If you want a good historical perspective on how exactly clearing works and the history of that, there's a great post that I read over the weekend. Just Google WTF is DTCC. DTCC is the Depository Trust Clearing Corporation. That's the plumbing of our markets. You just Google WTF is DTCC. There's a good post that explains the history of clearing and how it works. And so that's what I wanted to add about, not really about payment for order flow, but related to that conversation. Palantir. Let's give you those numbers here. Their earnings per share missed an 8-cent loss versus a 2-cent gain estimate. I'll bring up the chart here for Joel. Sales of 322 versus $300 million. No, you have it. So two things I'll add though. Remember, Cathie Wood has been buying Palantir in her ARK funds, and also the lockup expiration expires on Thursday.
Couple competing factors there. We know Cathie Wood's been buying Palantir on dips. You look like you're going to get a dip here this morning. So does she buy it tonight? She might. Is that going to be, do I want to come in here right now because Cathie Woods might buy tonight? Well, it's still in full price discovery mode here, 16 million shares. I don't want to be like, coming in here and saying, oh yeah, Cathie will buy tonight, it's going to come back, and then it's at 25 and it bounces up to 26 and you lose $4. So I think you let the dust settle here a little bit. Momentum has kind of broken in this name too, Joel. I mean, you think about all the small, this is concerning to a certain extent. It didn't make a new high on the last move. The momentum is broken. It's a name that everybody's piled into, so it's a crowded trade. So could this see 25 again? I'd be a buyer on a trade at 25, but you're still 5 points away from there.
Yeah, that's exactly. Well, yeah, you're getting a nice bounce here. And I was looking at also mid-range in this whole move from $9 to 45 is 27. So I'm thinking 25 to 27 range, but, am I being too cheap? At least that's what it's looking like right now. You hit $28, you got a nice bounce off 30. But when you see this many lows and up and, in the same area, just above and just below, I think that's where your patient buyers are. If you think they just whooped it up on the report and Cathie's coming in and buying 7 million shares tonight, then buy it. Lean on. I just want to see it take out the pre-market low. If that's your trading style, that's your risk reward as the S&Ps are about to crack 39.40, then lean on that 28. But it's really on the daily chart. It's really in no man's land. It had a big move off 25.82, so don't have much to substantiate that. But it depends what your risk appetite is, and if you're waiting for factors that you can't control, like Cathie coming in tonight and buying it, then you have to lean on the 28.
I mean, it's hard to just say, I'm going to get ahead of the Cathie trade, too. I mean, sometimes you actually see this, and, we could talk Cathie trade for a second because everybody likes talking it, but sometimes when it's anticipated, there's a big dip in this, and she's going to buy it, she doesn't buy it, I actually see those stocks go down. So, we talk about what goes up all the time, but if it's an obvious one that sometimes she buys something for 5-6 days, and then you'll see it actually trading up because people are anticipating she's going to come in and buy it again, and then she doesn't buy it, and then it goes down. So it's like, it gets punished because she didn't buy it. So, and she had been buying the stock for 6-7 days. She has that much influence that when she stops buying, there's actually a little bit of give back in the stock, because she didn't buy it. So it's not just a slam dunk that, she'll buy Palantir, so it'll probably go up tonight. Do I think she's going to buy Palantir? I think there's a chance she might. She may also wait for the maybe she doesn't like the earnings report. She's a fundamental trader. There could be some other things too. Just coming in a stock because you think Cathie's going to buy it, though, is a little bit of a dangerous, especially after they just report earnings.
Just real quick, I just want to do a couple more. Bluebird Bio. You never want to see this. They suspended a trial this morning. There was a report that a patient who was treated with their drug more than 5 years ago in Group A was diagnosed with leukemia. So they call this a let me pull it up here. Just had it. They call it a suspected unexpected serious adverse reaction. SUSAR is the acronym there, but you never want to see that.
This is I've got this in my long-term portfolio. I bought it back because when Kite got bought, I've owned this for a lot of years. When Kite got bought, and when who's the other one that got bought? There was three of them that always traded again.
Shoot, it was
Kite. What was the other one?
Oh,
but
gosh.
The three I always pair together. 2 out of the 3 got bought, and I was like, okay, they're going to probably buy. Eventually, somebody's going to buy Bluebird Bio too. It never materialized. I probably should have sold it. And now, their own company is not, obviously it's still burning cash, and now you get a trial that doesn't work out, and this has not been a good one for me. So this could be one of these that I'm going to write off at the end of the year. We're going to see. But it's been my long-term portfolio for a long time, and it's been a complete dog.
Oh, boy. Bounced off the pre-market low, if you want to use that as a reference point. What was that? 28.56, so it's $5 above that. So I think if you come back in, you even see buyers step up at 30 after that. But just a long-term chart here in this. I mean, it's just kind of telling you, like, I don't know where, how low. Maybe draw a trend line off this 2018 high and 2019 high. That's a pretty steep one. Maybe catches the July of 19 high as well, and maybe wait for it to break. But not much to say about it.
Yeah, it's hard. These stocks going down. So let's get 2 or 3 more in because I know we went on the plumbing talk. I'll stick a little longer because we went on the plumbing talk for a long time, and some people are upset that we didn't talk a lot of stocks. So somebody's saying NEO. Again, overall market matters here. NEO looks to me like it's in consolidation station to go higher. I'm not long the stock. I kind of want to be. I've been in NEO a few times. It's been a ridiculous run for it. I always look at XPEV when I'm looking at NEO as well. XPEV looks a hell of a lot more tired, which makes me somewhat concerned from a pairs trader perspective because if XPEV starts going down, they could hit NEO. But just looking at NEO, taking everything out, just looking at the technicals, it kind of looks to me like it's in consolidation station to eventually go higher. Joel?
I'll take the other side on that one.
That's cool. That's why we have a market.
Yeah, it hit the high. You had to break. It came down, had another run. You got up to that same area. I think if you're looking at it for a trade, you really want this thing to continue, you got to get above that high from last week. Just looks kind of tired. Holding yesterday, holding the low from Friday. We're trading up 30 cents here. I don't know. It could bounce between 55 and whatever this high, 67 for a long time. But, man, I know the long-term trend is up. It's had the consolidation. Just looks a little tired to me.
And it's you've been trading that Bumble?
Ha!
Oh, jeez.
No.
Let's bring it up, though.
BMBL?
Yeah,
it's what the world needs, another dating service during a pandemic.
I don't like day 1. I don't like day 2. Fari always says he wants 6 months. I would get down dirty way before that, but I like a few days. I mean, it's too wild yet. I want to calm down a bit. So that's when I start to get down and dirty in it. So another week, I'll probably start trading Bumble and add it to my universe. Right now, I haven't even added it to the universe yet because I don't want to trade it. The reason I do that is I'm disciplined. I like to control the risk. When you're seeing stocks move around in 20% ranges on a daily basis, it's difficult to control the risk.
Show me it can hold 77.50. That's it. Show me. I mean, that's only 2 days of price action. A low on the initial day at 70, a high on the second day at 84.80 or 85, 15-point move. That's show me you can get in here, make a couple days, hold 77.5, and then take off. If not, but like once again, a dating stock during a pandemic, I don't know.
It's been doing well, man. Match has just killed it, though. So they said I guess you can't go to a bar. Logic doesn't work on that one. You'd think, who's going on dates? But, virtual, I guess.
Virtual dates.
Virtual dates. It's still working. You can't go out and meet people in a bar, so you go on Match. I mean, so a lot of this actually does kind of make sense if you think about it.
Okay.
Maybe.
Right.
I don't know.
What about all these SPACs? I mean, we got and we're going to have SPACs attack on at 11 o'clock, but, I'm seeing SPAC names thrown at me.
Yeah, CCIV has been doing some weird stuff lately.
Oh, wow. That has just been exploited. They still don't have the deal, do they?
No, that's why I said it's doing some weird stuff because I don't.
This is Lucid Motors, right?
Yeah, well, supposed to be.
It's still just rumors. It's at $37 on the 10 on rumors. If they don't get the deal, So if they get the deal, but the problem is even if they get the deal at this point, how much more upside is there?
Yeah.
Maybe it is. Maybe it's like huge, obviously it's a big name out there in the SPAC world and it's a big name out there to get. So, but if they, for whatever reason, if they don't get it, this thing be back at like $15. So you got to be careful. Risk reward here when they still don't have the deal confirmed. It's probably getting it. They're probably getting the deal. But again, even as this, it's run up so much, 39 on the 10. So I can't come in here up here now. I've been ringing the register, and some of these are just getting silly. I mean, some of these SPACs names pre-deal are trading 30, 40, 50% premium. Bill Ackman's trading like a 60% premium now. It's 20. I believe 20 is Bill Ackman's. It's 32 this morning.
No. Oh, he started at 20. Yeah.
Yeah, so it's 32. It's 60% premium. He doesn't even have a deal. There's not even a target for Bill Ackman. So I mean, it's a little bit of a craze. Like it's been running, but I've started lightening it. Not PSTH, I didn't yet because I love Bill Ackman. I still think he's going to get a great deal, and I said to myself I was going to hold it until I got a deal. But he gave him a 60% premium pre-deal. It better be a dang good deal.
Yeah, it better be. Joel, how was Marriott trading this morning?
Do you have something on Marriott?
I don't know. This
What
is
is
like
it? What's the headline?
Not something you like to talk about, but the CEO suddenly passed away. They announced it this morning, so I guess it was sometime over the weekend. The president and CEO Arnie Sorensen. I'm just curious.
Ignoring it. It's just trading up with the market at 130. So
Yeah,
Marriott's been a stock that's come back a long ways from the pandemic lows too. I mean, this got down to $50. It's basically back up to almost where it was. I can't get on the hotel chain, and it's sorry to hear about the CEO. It's awful news. But it's hard to get on the hotel chain and say, okay, yeah, let's get on these hotels. Are we going to have this big boom after with COVID, and maybe that drives it? Maybe. But I mean, these stocks are all back to where they were pre-pandemic.
Hey, actually, you know, Joel, can you pull up Airbnb? I haven't looked at Airbnb for a hot second, and I would like to, because that's the way I'd play it. The COVID bounce back is Airbnb.
That's still eating, and you're making a great point. It's like Uber to the taxi companies. Airbnb is to Marriott and Hilton. I mean, there's a full attack on their business model here happening. And do you want to go and jump in a Marriott or Hilton? Do you want to pay a valuation of Airbnb? But there's no doubt that we used to always go to hotels, me and my wife, before the pandemic when we actually went out. But in the last year or two, we were always doing Airbnbs as well. It's more fun.
You know what? Someone advertised that they had a house with an indoor pool for rent, and like Lisa tried to get it, and like they're booked up for like a year.
Jeez.
Oh, for sure.
Jeez.
Yeah,
that's crazy.
Right there. If you want, I mean, this is right at its all-time high. So if you're using that as an indicator, I mean, the Marriott came a long way back. You got an all-time high at 219.94. So I don't know. Marriott's come back for you if you've been holding it. I pulled it up. I don't know if it's really moving on this news, but it got a lot after making that 135 high. You got a lot of resistance at 132.47. It's been up there 4 or 5 times since December.
Yeah, I mean, just going back to the Marriott, in case it wasn't clear, obviously, like that's not something that I like to talk about.
No,
I was just curious what
if there was stock reaction.
Sometimes there is a reaction. Sometimes there's obviously horrible news. You never like to hear that.
Yeah.
It's more interesting when the CEO resigns, like in Intel.
Yeah.
And they just goose the stock.
Yeah.
And then
it went up. Yeah, I know when that happens.
And then it came down. Did it fill the gap there?
Where is Intel? I sold it into that pop. Mm-hmm. Yeah, it's higher. So again, you regret the sales because I think I sold it like 58 or 59 that day. When it went from like on the CEO news from 51 to 60 in one day, I was like, I sold the next day. I didn't sell the first day. I sold the next day when it didn't get back through the 60, but then we eventually had broken through there. So
wow,
I'm out of my Intel now, but wow.
That filled the gap by 55 cents and now back up. You know who, and we can wrap the show after this. You know who's super bullish Intel?
Sean Udall.
Sean Udall. Yep.
He's the value guy, though. So he's going to look at this and say, why would it not be bullish Intel at 11 or 12 times? I just say it's because it's,
Well, he thinks that there's a big shortage in chips, right?
I like the Intel story still.
That's a fact.
Right. And is it Intel the largest U.S. chip maker, right? Am I correct on that or not? I thought he said that.
Maybe.
So, and also Biden's been talking about different things to, different programs. So I don't know. I mean, he has his Qualcomm goggles on this one.
But he's a value guy. Qualcomm was value down there too. And
right.
Eventually, this is his kind of market. A lot of the value stock names have come back. I mean, this has been, you can say, this has been driven by growth, but you look at a lot of those value names, and they've come a long ways too. Some of the value names have come back. So It's been just a rotation out of what was, the mega caps and moving into everything else. And value has benefited from that too. I mean, this Intel, I hope it comes back down to 45 again because I'm going to keep playing this forever. Every time it gets down to 45, I rebuy it. And it gets up to 55 or 60, I sell. I've done it, I think, twice now. I could have did it three or four times, really. So I hope he eventually comes back down. I don't know if it's going to.
All right, public service announcement today is the 16th. First of all, happy Mardi Gras to all you celebrating. But it's also a holiday on Wall Street. Yes, it is 13F Day today.
Oh, man. Is that tonight?
It should be.
Oh, it's always a tough night to trade. You're like, what's happening here? And so there's so much, news on individual stocks. This person bought, this person bought it.
Maybe we're going to get some comments from Warren Buffett on Bitcoin. I don't know. I'm just speculating.
I heard he's got a new stock.
Is it Bitcoin?
I don't know.
I don't know. We will find out tonight.
There's rumors he's got a new stock, though.
I expect, if not tonight, then tomorrow for sure. I don't know how the holiday factors into things. But, 13Fs, we're going to find out which stocks hedge funds were buying and selling. Again, this is for the fourth quarter, so very delayed, but still can move stocks, especially if it's Warren Buffett. Occasionally, another fund manager will move stock as well, but always. So that'll be tonight. That'll be after hours. So keep an eye on that. I want to thank our guest today, Bill Harts. I haven't said this enough on the show today, but hit that like button, hit subscribe, hit share, post it on Twitter or MySpace or wherever the kids are these days. We appreciate that. The show is also available as a podcast. If you're listening via podcast, please remember all the information from our show is meant to be used as informational purposes and not for investing or trading advice. That's going to be it for Pre-Market Prep. Everyone have a great day. Joel, Dennis, thanks very much.